$1 trillion, wiped out in 6 weeks. But here's what nobody's telling you. This wasn't about Bitcoin. It wasn't about tariffs. It wasn't about China. $1 trillion vanished because of a weapon that's been deployed in every single crash throughout history, 1929, 2008. And now, October 2025. The weapon isn't stocks. It isn't crypto. It's something far more dangerous, and it's inside your portfolio right now. Bitcoin didn't crash the market. Bitcoin was the alarm system screaming that the real monster had woken up. Let me show you exactly what's really happening. On October 10th, 2025, $19 billion in crypto positions were liquidated in 24 hours, the largest single-day wipeout in crypto history. Bitcoin crashed from $126,000 to $81,000, a 30% drop. Ethereum tanked 14% in minutes. Over 1.6 million trader accounts wrecked. Gone. Liquidated. The media blamed Trump's tariff announcement. They blamed China. They blamed crypto itself. Here's what nobody tells you. The tariff announcement was just the match. The real bomb had been ticking for months. And here's the disturbing part. The exact same bomb detonated in 1929. It obliterated the market in 2008, and it just went off again in 2025. Wall Street knows this. The Federal Reserve knows this. But retail investors, they're the ones holding the bag when it explodes. Before October 10th, margin debt in U.S. markets had surged 45% in 1 year. Meanwhile, the S&P 500 only rose 19%. That's a 2.4 times divergence, borrowed money growing more than twice as fast as actual market value. This exact pattern appeared before 1929, before the dot-com crash in 2000, before 2008. And here's what makes it deadly. When leverage grows faster than assets, the math doesn't add up. Someone's gambling with money they don't have, and when the music stops, the liquidations become automatic. Let me show you how this machine actually works. In 1929, investors could buy stocks with just 10% down, 90% borrowed. When prices dropped even slightly, brokers liquidated everything to cover their loans. $3 billion in forced sales in 10 days. In 2025, crypto traders were using the same playbook, but on steroids. 10 times leverage, 20 times. Some platforms allowed 100 times leverage. Here's the trap. When Bitcoin drops 10%, a 10 times leveraged position loses everything. The exchange automatically sells your collateral. That selling pushes prices lower, which triggers more liquidations, which causes more selling. A death spiral. During the October crash, market makers, the firms that provide buy and sell orders, pulled out completely. No buyers, no liquidity. Prices fell into a void. Some altcoins dropped 70% in minutes because there was literally nobody on the other side of the trade. Order books evaporated. The real killer wasn't even visible. Traders were borrowing through peer-to-peer platforms, using DeFi protocols to stack leverage on leverage. Some positions were leveraged 10 times over through recursive borrowing. Exchanges had no idea. Regulators had no idea. Even the traders themselves didn't fully understand their exposure. When the crash hit, this hidden leverage detonated like a landmine. So who profits from this machine? The exchanges, the market makers, the institutions with access to better data, faster execution, and insider positioning. On October 10th, while retail traders were getting liquidated, one whale held $1.1 billion in short positions. They made $80 million in 24 hours. This is not theory. This is documented fact. Binance's insurance fund paid out $188 million to cover bad debt from the crash. Hyperliquid liquidated $10 billion in positions, the highest of any platform. Meanwhile, institutional investors, they were buying. As retail panic sold at the bottom, institutions saw the crash as a prime opportunity to acquire fundamentally strong assets at a discount. They don't want you knowing this, but the pattern is always the same. The wealthy get the warning signs. They position accordingly. Then they buy the chaos they helped create. In 1929, JP Morgan and other banking titans tried to stabilize the crash, not to help retail investors, but to protect their own positions. When that failed, they bought assets for pennies. In 2008, investment banks that created toxic mortgage derivatives got bailed out with taxpayer money, while homeowners lost everything. In 2025, the game hasn't changed. Only the asset class. We've seen this before. We're seeing it again. October 1929, excessive margin trading, 10% down payments. When prices dropped, $14 billion vanished on Black Tuesday. The Great Depression followed. October 2008, banks over-leveraged on mortgage derivatives. Lehman Brothers collapsed. The Dow fell 54%. Millions lost their homes. October 2025, crypto over-leveraged on perpetual futures. 19 billion liquidated in one day. Bitcoin crashed 30%. Different assets, same weapon, leverage. Here's the pattern. Every major crash follows a period where borrowed money grows faster than real value. The debt bubble inflates. Confidence peaks. Then one trigger, a tariff, a bankruptcy, a tweet, and the whole structure collapses. In 1929, it took brokers' loans from $8.5 billion to $5.5 billion in 10 days. In 2025, it liquidated $19 billion in leveraged crypto positions in one day. The speed has accelerated. The scale has grown. But the mechanism is identical. Markets rise. Everyone profits. Confidence soars. Traders borrow to amplify gains. Leverage multiplies across the system. Margin debt grows faster than asset values. A trigger event hits. Tariffs, regulation, a bank failure, anything unexpected. Prices drop slightly. Leveraged positions hit their liquidation threshold. Exchanges automatically sell collateral. This selling pushes prices lower. Lower prices trigger more liquidations, more forced selling. The spiral accelerates. Market makers withdraw. Liquidity disappears. Prices collapse into the void. Retail investors panic. They sell at the bottom. Institutions buy the dip. The cycle resets. Lessons are forgotten. Leverage builds again. Why does this system stay intact? Because it's profitable for those at the top. Exchanges make money on liquidations. They keep the collateral when positions get wiped out. Market makers profit from volatility. Institutions with capital and information buy assets at fire sale prices. The system isn't broken. It's working exactly as designed. For them, this isn't conspiracy theory. This is documented fact. Right now, as you watch this, margin debt in traditional markets equals 3.6% of US. GDP approaching the record 3.97% set before the 2021 crypto crash. On an inflation-adjusted basis, margin debt is now 6.7 times higher than 1929 levels. The Fed just signaled it might not cut rates in December. That means borrowing costs stay high, which means over-leveraged positions are getting squeezed right now. Bitcoin crashed 30% in 6 weeks, but the S&P 500 only down 3%. That divergence tells you everything. Crypto is the canary in the coal mine. It moves first because it's leveraged heaviest. But traditional markets carry the same disease. Smart money is already moving. Institutions are rotating into defensive sectors. Healthcare, utilities, gold. They're trimming leverage. They're preparing. The window is closing. Here's what you need to understand. The next trigger could be anywhere. A Fed policy mistake, a bank failure, a geopolitical shock. It doesn't matter what lights the fuse. The leverage bomb is already in place. What can you do? 1. Check your exposure. If you're using margin, understand that a 10% drop could wipe you out completely with 10 times leverage. 2. Understand the pattern. When borrowed money grows faster than real value, corrections aren't possibilities, they're mathematical certainties. 3. Build a defensive position. Don't put everything in high risk, high leverage plays. Diversification isn't sexy, but it's survival. 4. Watch the signals. When margin debt spikes, when the Fed gets hawkish, when Bitcoin leads the market down, these aren't coincidences. This system has destroyed wealth for a century. 1929, 2008, 2025. It will happen again. The only question is whether you'll see it coming. Share this with everyone who needs the truth. Because the next crash won't announce itself. But the alarm is already ringing.